Welcome back to the deep dive. Today we are getting into something really fundamental to corporate finance. We are taking a deep dive into the balance sheet.
Right, and we're going to forget the big headlines about quarterly earnings for a minute.
Yeah, because this document, this is the real snapshot of a company. It's a precise measure of its financial position at one single moment in time.
And our mission today is to really unpack that internal structure. We want to understand the core logic that makes the whole thing, balance.
Think of it like a reckoning.
Exactly. A bit like the Doomsday Book for a company. It's a full list of everything the company owns or controls, those are the assets, and everything it owes to its creditors, the liabilities.
And the difference, what's left over between those two, that's what belongs to the owners, the stockholders' equity.
That's it. And that brings us to the unbreakable foundation of all of this, the accounting equation. Assets must always equal liabilities plus owner's equity. No exceptions.
If that equation doesn't hold, you're not looking at a balance sheet.
You are definitely not.
Okay, let's unpack the structure then. The first thing you notice is that everything is categorized. It's not just one big lump sum of cash and debt.
No, and that classification is absolutely crucial. Accountants separate everything into current, so short-term, and long-term, or non-current.
And that split is what helps you assess a company's liquidity, right? Its ability to pay its bills over the next year.
Precisely.
So let's start on the left side of that equation, assets, what the company owns, and we begin with current assets.
Right, the stuff expected to be used up or turned into cash within a year.
And at the very top of that list is always
Cash and cash equivalents. So that's your currency, your bank balances, and very high-quality short-term investments.
like 3-month treasury bills.
Exactly like that. For a company like Microsoft, this can be tens of billions of dollars. It shows you just how critical those short-term funds are.
Okay, next up we have accounts receivable.
Which is just the money owed to the company by customers. And it's always reported net, meaning after they've estimated an allowance for bad debts.
That's a number analysts watch really closely. I remember the Sears example was just, it was so stark.
Oh, it was. They drastically cut their receivables from, what was it, over $30 billion down to $2 billion.
And they did that by selling off their credit card receivables.
They did. And that completely changes the company's liquidity picture. You get a huge pile of cash now, but you give up that future stream of revenue.
And the customer relationship that comes with it.
Right. We also have inventory, which for a retailer like Walmart is obviously huge. I think it was reported around $44 billion.
And then there's one that's often overlooked, prepaid expenses.
Yes. Payments made now for future benefits, like prepaid rent or insurance. It's an asset because it means you won't have to spend that cash later on. IBM once reported $4 billion in prepaids. It can be a big number.
So once we look past that 1-year horizon, we get into long-term assets. And the biggest category here is property, plant, and equipment, or PP&E.
Yes, and this is where things get a little more complex because we have to introduce accumulated depreciation.
The famous contra-asset account.
That's the one. PP&E is put on the books at its original historical cost, but then, year after year, we subtract the accumulated depreciation.
Which is the total amount of that cost that's been expensed over the asset's life.
You got it.
So if you look at a company like ExxonMobil, their PP&E might have an original cost of, say, $409 billion.
A massive number.
But then they've got accumulated depreciation of maybe $182 billion. So that net number, I mean, how much faith should an investor really put in that? It feels a bit like an accounting fiction.
Well, that's the central tension of the balance sheet. That net value is purely an accounting construct. It is not the current market value.
Right. It's not what you could sell it for today.
Not at all. It just tells you what portion of the original cost has been used up. That's it.
And speaking of things that don't reflect current reality, let's talk about intangible assets, patents, goodwill, things like that, because there's one huge rule here that just seems to create a massive disconnect.
There is. The rule is that only purchased intangibles get recognized on the balance sheet.
So if a company buys another company and pays a premium, that premium gets recorded as goodwill.
Correct. You see it with Altria, for instance. They reported something like $17 billion in intangible assets, and most of that was goodwill from buying other brands.
But, and this is the paradox, the incredible, world-famous value of their own homegrown brand, Marlboro.
It's not on the balance sheet.
It's just not there.
It's not recognized as an asset because it was never purchased in an external transaction. The company built it internally, and the accounting rules forbid them from just, making up a value for it. It's meant to prevent subjective, inflated numbers.
So wait, a brand that is arguably the core of the company's value, worth billions and billions of dollars, is completely excluded from the assets column.
It is.
Doesn't that make the whole thing fundamentally incomplete for an investor?
It absolutely does. The huge caveat. The rules are prioritizing objectivity over relevance in this case. You have to go digging in the footnotes for that kind of information.
Wow. Okay, that's a perfect transition to the other side of the equation. We know what the company has. Now, who has a claim on it? Let's talk about liabilities.
Liabilities follow that same logic. Current versus long-term. Current liabilities are what's due within 1 year.
Things like accounts payable money you owe to your suppliers.
Exactly. And also accrued liabilities. These are expenses you've incurred but haven't paid yet.
Like wages for your employees or taxes?
Right. A company like Walmart, with its massive scale, reported about $19 billion in accrued liabilities. It's a key part of their short-term cash planning.
Then there's the one that always seems a bit counterintuitive. Unearned revenue. The company gets cash, but it has to record a liability. Why?
Because you have an obligation. You owe a service or a product in the future. Think about a software subscription. You pay for 2 years up front.
So the company has my cash, but they haven't earned it yet.
They haven't. They owe you 24 months of service. When Sears sold appliance service contracts, that cash created a liability, an obligation to provide future repairs. It only becomes revenue as they deliver that service over time.
Okay, that makes sense. Moving on to long-term liabilities then.
This is stuff due after 1 year. The big one is long-term debt bonds, mortgages. For a capital-intensive company like AT&T, that was $66 billion. It's a huge part of their risk profile.
And you also see enormous commitments here, like pension obligations.
A massive one. For a company with a long history like GM, they once had a pension obligation of over $111 billion. That is a huge, non-cancelable claim on their future cash flows.
All right, so that brings us to the final piece, stockholders' equity, the owner's residual claim. Where does that capital come from?
Primarily 2 places. First is direct investment from shareholders. That's your common stock and additional paid-in capital.
And we should probably note that the par value you see on a stock certificate is just an arbitrary legal number.
Oh, it's totally arbitrary.
Yeah.
The real investment is captured in that paid-in capital account.
And the second source, which for most big companies is way more important,
is retained earnings.
Uh-huh.
This is the grand total of all the net income the company has ever earned and decided to reinvest back into the business instead of paying it out as dividends.
The Coca-Cola example really drives this home.
It's a perfect illustration. Their retained earnings were around $58 billion, which was 5 times larger than all the direct stock investments combined.
So the real engine of growth isn't new capital. It's just the compounding power of reinvested profits.
For successful, mature companies, that is absolutely the story.
And just like assets, there's a contra account for equity too, isn't there? Treasury stock.
Yes. Treasury stock is what the company paid to buy back its own shares from the open market. Since it's cash that has left the company to go back to shareholders, it gets recorded as a subtraction from total equity.
So we have this whole structure, but it's static. It's a snapshot. You mentioned articulation earlier. How does this connect to the other financial statements?
That's the genius of the whole system. They all talk to each other. The net income from the income statement flows directly into retained earnings on the balance sheet.
And the statement of cash flows.
That statement is designed specifically to explain the change from the beginning of the year to the end in that one line item. Cash. They are all intrinsically linked.
Okay, we've covered the structure. Now for the logic. How does an accountant even decide what gets to be a number on this sheet? This brings us to recognition and valuation.
This is where the real philosophy of accounting comes in. For anything to get on the balance sheet, 2 big decisions have to be made. First is recognition.
Which is the act of formally putting a number on the statement itself.
Right. You're summarizing a complex item into a single dollar figure. But if you can't do that reliably...
So you have to rely on disclosure.
Correct. Disclosure is where you use a narrative note to explain something, like a major lawsuit, that you just can't quantify with any certainty.
And what are the criteria for something to be recognized?
Well, it has to meet the definition of an asset, liability, or equity, and, this is the critical part, it has to result from a past transaction or event.
That emphasis on past is huge. Let's take McDonald's. They're basically a giant real estate company.
Absolutely.
They have billions of dollars in future rent payments coming to them from their franchisees. A massive future cash stream.
A huge stream.
Yeah.
But those payments are for the future use of the property. They're not the result of a past transaction that gives them a right to the cash today. So that massive future receivable isn't recognized on the balance sheet.
It's just a promise of future transactions.
That's all it is.
So once we decide something can be recognized, we hit the second challenge, valuation. And this is a balancing act between two competing goals.
It's the great trade-off in accounting. Reliability versus relevance.
Okay, explain that.
Reliability is usually achieved through historical cost, the original price you paid. It's objective, it's verifiable. We can all agree on what the building cost 10 years ago.
But it's completely irrelevant for making a decision today, right? What it cost 10 years ago doesn't tell me what it's worth now.
And that's the failure of reliability.
Hmm.
So the other side is relevance, which is usually achieved with market or fair value, what it's worth today.
Which is highly useful, but it can be subjective.
Very subjective and volatile. I mean, you just have to think back to the Enron scandals. Subjective valuation of complex assets was at the heart of the fraud. The system is terrified of that.
So the balance sheet ends up being this kind of blend. Cash is at market value, but PP&E is stuck at historical cost.
Exactly. And that inability to reliably value something, even if you know it exists, like the future cost of a toxic waste cleanup, is what keeps it off the balance sheet and pushes it into the footnotes.
Let's turn to how this is all presented. We know the U.S. standard, but there are global differences that they actually reveal different business priorities.
They do. In terms of just the format, you've got the side-by-side or account form, which literally puts assets on the left and liabilities and equity on the right.
Visually showing the equation.
Yep. And then there's the columnar or report form, which is vertical.
Which is more popular now.
Much more popular because it's easier for spreadsheets and comparative analysis. And you almost always see them presented with 2 years side-by-side, like 2023 versus 2022, so you can spot trends.
The U.S. standard puts a huge emphasis on liquidity. We list current assets first, starting with cash, the most liquid.
But that changes in other parts of the world, especially in countries with a British influence. Their VART format often lists the long-term assets, like PP&E, first.
Why do that? What's the business logic behind putting the least liquid stuff at the top?
The goal of that format is to answer a very different, very structural question. It's trying to answer how much permanent long-term financing does this business need to run?
Okay, so it's focused on the foundational capital structure.
Exactly. And to do that, they actually use the concept of working capital right in the presentation.
Right, which is current assets minus current liabilities.
They call it net current assets. And this number represents the permanent investment needed for the day-to-day operating cycle, the bit of inventory and receivables that you always have to be funding.
So they list the long-term assets first, then they add that working capital number.
And the total gives you the answer. Total permanent funding needed is your long-term assets plus your working capital. It shifts the focus from short-term liquidity to long-term funding stability.
That really brings our whole deep dive together. The balance sheet is this highly structured snapshot. It's rigid. It has to follow that equation.
And every single number on it represents this trade-off between reliable history and relevant but subjective current value.
And the way it's segmented lets you analyze everything from short-term cash crunch risk to long-term funding needs.
I think if there's one key takeaway, though, it's that the balance sheet's strict rules, the ones that prioritize objectivity, they force certain economic realities completely off the page.
We talked about this. The premium paid for an acquisition, goodwill, gets put on the books as an asset.
It does.
But the incredible multi-billion-dollar value of a homegrown brand like Marlboro is just ignored. It's not there because it was never bought.
Which leaves an important final question for you, the person looking at these statements. When you see this otherwise comprehensive report, what critical information about a company's true economic power, its brand, its R&D, its human capital might be missing simply because it was built, not bought? You could have a sheet that balances perfectly, but still be missing the most valuable part of the story.